Good evening, everybody, and a very warm welcome. This is Tideway's second client webinar of 2023. Our subject today is the Chancellor's Spring Budget, the good, the bad, and the ugly. By way of introduction, my name's Seymour Banks. I am delighted to be joined by two of the very senior members of Tideway's team. Well, it doesn't get much more senior than you, James. I'm sure all of you recognize James as the founder of the Tideway business. And on my left, I'm joined by Sam Ratnage, one of our senior wealth managers. Sam joined Tideway in 2015, and so he's been with us already now for 8 years. In terms of the timing of today's webinar, I think it's pretty good because it's just over a month now since Jeremy Hunt announced the end of the lifetime allowance to pensions in the budget, and that was a bit of a shock. But we've allowed a little bit of dust to settle in that time, and certainly there was a lot of dust swirling around, as we said. As I said, interest certainly initially has been very high. We think we're going to break our webinar attendance record, which is good news. And perhaps that's also a reflection of the fact of the relevance of this particular topic for many of our clients. We estimate actually that a couple of 100 have been impacted by the ending of the lifetime allowance alone. As in previous occasions, we do look forward to a dialogue and to answering your questions as we go along. So please enter them in the Q&A. We've actually already received a few, so we'll look to answer them as we go along. Certainly, if we don't get time, feel free to speak to your wealth manager directly. You can always email questions to me at seymour.banks@tidewayinvestment.co.uk. But to get the ball rolling tonight, I'm going to hand over to Sam. Sam, what do you think of the budget generally, first of all, and how has it affected our clients? Was it good? Was it bad? Was it ugly? Was it all three?
Well, I think it was all three, Seymour. I think, the first thing, I'll start with the good. As Seymour already alluded to, the lifetime allowance is being abolished. It hasn't been abolished yet, but it's being abolished in April next year. But at the moment, if you had a lifetime allowance test, you wouldn't be tax chargeable to the lifetime allowance. Then there are a few other changes as well. The annual allowance has been increased, so that's the amount you can contribute to your pension. That's gone from 40,000 to 60,000. If you triggered what's known as the money purchase annual allowance, which is when you flexibly access your pension, the amount has gone that you can contribute has gone up to 10,000, and if you're a high earner, again you can do 10,000 a year into the pension.
What was it before? Sorry,
it was 4,000 on the money purchase allowance and on the tapered annual allowance, so it's increased quite a lot actually to go to 10,000.
And funny, if we've already got a question come in, I see, regarding the money purchase allowance. You say it's increased from 4,000 to 10,000. Is that a net or a gross?
That's a gross amount, so it's 10,000 gross. So if you're putting into your SIP, for example, you put in net because it comes out of your bank account and your net pay. But if you're paying from your employer's pension via your employer, it's often done gross at 10,000.
I guess one question I have, and it's another question reflected by one of our clients, is why is this taking so long to actually implement? You say at the end of the year. Why doesn't it happen straight away?
Well, there's quite a lot to do. It's not. There's quite a lot of infrastructure that needs to be changed with pension providers, and there's quite a lot of detail that's still coming out from HMRC about it. So we are still, I would say, waiting for a bit of dust to settle, and we've got time on our hands.
Okay. You say that the cap on contributions has been lifted. Question here is from one of our clients: to what extent can someone who's already started drawing down pension income make further contributions and continue to benefit from tax relief?
Well, if they've taken some benefits from the pension and particularly income, they have triggered the money purchase annual allowance, and that they are restricted to 10,000 to a money purchase scheme. But if they are in a DB scheme or an employer's DB scheme, they go back to the normal annual allowance, which is 60,000.
Very good. I think one other question. What impact, if any, does the above have on an individual's ability to join an employer's pension scheme?
Well, I think anyone who's been affected or stopped contributing or considered stop contributing or paused contributing because of the lifetime allowance, because of the money purchase allowance or the taper allowance, should really consider. doing it again, and talk to us about that.
More flexibility. So that's the good.
Yeah,
good start.
Yes.
What about the bad?
Well, the bad is related to the dividend allowance. That's halved, so that was at 2,000. It's now at 1,000. The capital gains allowance also was at 12,000 at 100, I think it was, and now it's gone down to 6,000. And both of those are being reduced. They've been reduced now, and they're being reduced again next tax year. I think the other bad news is that inheritance tax and all other income tax brackets have been frozen. So that in itself is a stealth tax.
I mean, inheritance tax has been frozen for quite some time. It seems like it's a hell of a long time since, are they considering, do you think, increasing that in due course?
There's not any rumours about that increasing. It has been frozen for quite a while, actually. Yeah.
Okay. Okay, so that was fairly simple. I mean, not great news, but not as dramatic, should we say, as the improvements following on from the abolition of the lifetime allowance. Onto the ugly.
Yes, I think. Well, the ugly is unfortunately political uncertainty. I think the opposition party immediately disliked the removal of the lifetime allowance, and their sort of knee-jerk or immediate response was that they'd reverse it all. I think that's obviously created quite a bit of confusion with some of our clients. The first question I get asked when I talk to someone about the lifetime allowance, which is, I've had a lot of conversations in the past few weeks, is what if Labour get in? And I think there's a few things to take into account. There's not an election due until the end of next tax year, so there is this entire tax year, and there's a new tax year, assuming that the election doesn't happen to that point. So there's a lot of time for people to make decisions, and they should make decisions. A future chancellor or government can do what they want effectively, but I think it would be incredibly harsh if they did come into power, if they completely reversed it. And there are a lot more sensible solutions that would that they could consider, but ultimately we just don't know.
I mean, I guess the other thing that's been left hanging out there, it's neither good, bad, or ugly, I guess, but the tax-free lump sum that people have been able to take out of their pension, limited to 25% of what was previously the lifetime allowance. No changes there. First of all, any comments regarding that? But secondly, in light of what you just said in terms of political uncertainty, what's your take on where that could go in future, both in the existing government, but also in any potential future government?
Well, your first point, tax-free cash, that hasn't been changed. So it's still linked to the lifetime allowance. So you still have a maximum link to the lifetime allowance, and you can't take any more than that at the moment, or unless you've got a protection in place. I think if you're looking at what the current government might do in the next budget, or a future government might do in the following budgets, I think that unfortunately they like to play around with pensions, and we will probably expect some changes. But what we just don't know.
James, I'd like to bring you in at this point. In light of this uncertainty, previously you've really advised your clients not to do anything, really, not to rush, certainly not to crystallize funds if they could avoid it. And now we're seeing the benefits of that inaction. What's your view generally, and how should we react right now to what's happening?
Well, thank you, Seymour, and thank you for everybody for turning up. I think we've got 25 people on the call now, so we have broken the record. Please ask some questions. This will be much more fun if some of you can stick some questions in the Q&A box, because that way we can actually make it live and interactive as we go forward. We did have a look. We had a look at most of our clients' pensions are at AJ Bell. So we have a nice report from AJ Bell, and I think we thought that 160 of our clients out of 600, so it's quite a large proportion, are going to be already over the lifetime allowance. And we think the maths we did is a little bit vague, because we don't know exactly, but we think you've all saved about somewhere between 10 and 15 million pounds collectively as a group of individuals, about 100,000 each as average. So it is it's a nice, it was a nice tax. And you're quite right, Seymour. Our advice historically has been not to crystallize it. We have had a very small number of people who did crystallize it, but the vast majority of you have followed our advice and only crystallized up to the lifetime allowance. So what you've all got is, when you look at your benefits on AJ Bell, you've got a portion in the drawdown account, which is already crystallized, and then a portion that's uncrystallized, which is above the lifetime allowance. And whereas in the past, when you tried to move that uncrystallized portion into the drawdown account, you'd have had to pay 25% away in tax. That is now gone. And that is going to be the obvious way to mitigate against the biggest risk here, which Sam has outlined, which is a future government trying to reverse things. Because once you've crystallized your benefits, once you don't have any more in the uncrystallized pot, then you are through the lifetime allowance check. And so any future fiddling around with the lifetime allowance, and it's almost guaranteed that if we do get a Labour government, they will fiddle around with it. That won't affect you if you've crystallized your benefits. So that is almost certainly going to be the advice. The issue is when we do it, and we don't see a massive rush to go out there and do it one case at a time, because we are, we're hearing from AJ Bell what they think is happening and what the rules are and how but they've got to change their IT systems, and they've got to change the way they manage the valuations of your accounts in order to take account of the fact that this split of assets between uncrystallized and crystallized is disappearing. So our considered view, we had a big old group discussion on this last week, is that what we're probably going to do is wait for a few months. The next real deadline is going to be the 5th of April or 4th of April 2024. So we've got almost 11 months to think about this.
50 weeks.
50 weeks, thank you, Sam. So there's no massive panic to do anything. We are completely on top of it. And whilst you all have each got one situation that you're trying to worry about, believe me, we're going to look at 160 over the next few weeks and months. So we will fully understand every permutation and every possible situation by the time we've been through that. So we will be able to advise you and anybody else that you're talking to who's got lifetime allowance questions. If they want to come to a firm that knows everything about it, that's going to be us. So I think the advice is going to be to crystallize your benefits. If you haven't taken your tax-free cash sum, we'd probably recommend, if you're at the limits, to take that tax-free cash sum. Those are going to be the first things. What else would you like to know, Simon?
Well, I mean, what's interesting is, so in terms of pensions advice, what's happening regarding this recent changes. Nevertheless, there's a bigger picture, isn't there, as well, out there in terms of the opportunities to increase tax efficiency. And my question for you, James, and obviously Sam, you can fill in as well, is how does it in fact impact our advice with respect to other allowances, other kind of tax efficiencies which we advise our clients? So, for example, on the extent to which they use their ISAs. In some cases, we do have individuals who have offshore bonds. Is it going to be that this is even more likely we will just want to put people in the direction of SIPs?
Well, I think the first thing to say is that there's a lot of people, and probably the 160 is quite close to it, who haven't been contributing to pensions because they know that they're at the lifetime allowance, or that they've got enough money in the fund that by the time they get to retirement, they will be at the lifetime allowance. And that cap has been lifted. So I think for everybody who's been close to the cap, it's got to be worth reconsidering whether or not pension contributions make sense for you as an individual. So pension contributions are still by far the most tax efficient way to accumulate wealth. For a 40% taxpayer, you're getting a 2/3 uplift on your money, or 1/3, whatever it is, but you're getting a tax-free uplift, which comes without any risk. So it's not like you have to make a risky investment in order to get that uplift. You put in £60 and it becomes £100 in your SIP. So if you're a higher rate taxpayer and you haven't been contributing, then you definitely want to come and talk to us, and we will work through with you whether it makes any sense to restart pension contributions again. And there are some big numbers up for grabs. So if you haven't been contributing for the last few years and you're lucky enough to have earnings above 180,000 but below the taper relief of 260,000, in theory you could put 180,000 pounds into your pension account this year, and you would get more than 40% tax relief on it, because at some point you go through the death zone, as we call it, the 60% rate, where you get over 100,000, you're going to wipe that out. You're going to get your nil rate band back. So the tax efficiency of doing a pension contribution at that level, if you haven't contributed, there are going to be a few of you out there who can really benefit from that opportunity. And we would, we'd encourage you to do it. But at the same time, we're also conscious that, the politicians can't keep their hands off these things, and they will fiddle around with them. And it's almost certain that they will have a go. And so we just need to be a little bit conscious of putting all our eggs in one basket. And so we would also encourage the use of ISAs and other tax efficient saving strategies, and not be 100% reliant on retirement just on one income stream, which may get taxed at a higher rate at some point in the future.
So we've got diversification in terms of tax efficient wrappers, obviously, as well as investments that we advise on. We do have a question here coming in on the issue of investments, and it's to do with the recent fallout in the banking sector. The question comes in: do you foresee any further downturns in the banking sector that would have a knock-on effect to our investments?
Well, thank you for sending that one in. I mean, it is a tax planning session, so we shouldn't really be answering, but we will answer it, because we like to do this. I don't think that I can certainly say that what we thought was a contained issue is a contained issue. And we had some stonking results from JP Morgan a week ago. And I do think that the risks from the banking sector, interestingly enough, today I got told that there were additional risks from the Twitter fallout. Mr. Musk obviously borrowed a lot of money when he bought Twitter, and a couple of banks in the US are holding most of that debt and would have collateralized it out to other banks and have not been able to. And so that's caused a bit of an issue as well in the banking crisis, which hasn't really been talked about in the mainstream press. But we're not expecting a banking crisis in the next 6 to 8 months. We don't think that there's contagion coming. So I'm going to say now, and touch wood, that we don't think there'll be any further fallout from that particular aspect in the next 12 months.
And it's fair to say that in terms of the portfolios that we have for our clients, they're already diversified, both in terms of managers, in terms of asset classes, and certainly in terms of sectors underlying that. So we do. That is the.
But we also see financials as actually quite a good place to invest right now. I mean, there's a number of reasons why. The financial crisis 2008, 2009 meant that regulators have put a lot of effort into strengthening the balance sheets of banks and insurance companies, so we see them as relatively safe places to invest. And also they generally benefit from rising interest rates. So most of their business plans look a lot better now with 4 or 5% base rates rather than 0% base rates. So, financials generally are a good spot to be. And in the debt market, particularly in our fixed income funds, there's quite a lot of financial exposure, which is one of the reasons why we saw quite a kickback in March when we did have that Credit Suisse issue. But a lot of that is coming back quite quickly, both in the equity markets and in the bond markets. So it does look like a temporary effect rather than a prolonged effect.
And certainly what we've seen is, I think, from banking sector generally is and governments, is the incentive to react quickly in light of what's happened in the past. So it would appear that there's a certain amount of coordination going on at the same time. Yeah. Question coming up.
Get back onto the pensions.
back onto pensions, where I know Sam feels a lot more confident. But Sam, we've got one here. Do you believe that once crystallised, Labour could not apply a backdated lifetime allowance tax? That does seem a bit harsh, I have to say, but nevertheless.
I'd agree. It seems harsh. Ultimately, a Labour government or a future government can do what they want, so they could do that, but it seems extremely harsh. Often they've backdating things, whenever they tweaked around with the protections before, and the lifetime allowance, they've allowed you to protect it. So you'd think that they would do something like that, but ultimately we don't know. We're speculating, so they could do that. But I would think that would be extremely harsh.
I would agree, Sam. I think that's, you know, highly unlikely. I think that they're, you know, in all of these things, you can't do things retrospectively where people have planned. And one of the things when we first came out, Sam said, well, there's 2 tax years. And that's a really important issue here, is that we have 2 tax years in which to apply these new rules without the lifetime allowance. People will make plans, they'll do things, they'll do planning. And therefore, you know, you can't keep going back at people. And when they brought in, I guess, you know, it's worth reminding ourselves that the lifetime allowance was a Labour introduction. I think Gordon Brown brought it in 2006 A-Day. So it is a Labour tool, and it's been deeply unpopular, not just by people with large pension pots, but by the pensions industry generally. It's, you know, it's also extremely difficult to understand, difficult to tax, difficult to work out. So I think there's a real windfall in terms of it's much simpler to administer pensions without it, and it's going to be cheaper to administer pensions without it. So I think that it would be deeply unpopular within the industry, within the pensions industry, to bring it back in. I think it's deeply unpopular within certain, you know, certainly within the civil service and within the NHS for the higher paid people, which is one of the reasons why, you know, potentially was brought in. And I think that, you know, whilst they may try and bring it in at a, you know, maybe they bring it in at 1.5 million or something like that, that will be, you know, for going forwards, the people who are through and who've crystallized their benefits whilst it's zero, you know, whilst there is no lifetime allowance, will not be subject to further. That would be my view.
So that'd be a reason then for advising in due course.
Absolutely,
to
to crystallize now. Yeah, I mean, I think if you're putting in bigger contributions, and if you're putting in bigger contributions, or indeed you're one of these people with an excess account. So someone is asking now, what is crystallization? What does it really mean? So when you start a pen, well, first thing to do is to remember that pensions are basically trusts. So you don't own the money, the trustee owns the money on your behalf. And it comes from the original legislation. There used to be deferred annuities. Slowly over time, they've morphed into what we now see as the modern DC pension. You don't have to buy an annuity. You've got these drawdown rules on the other side when you retire. But the basic point at which you crystallize is when you take money out of your account. So the way to take money out of the pension account is either as a lump sum, which is tax-free, or as an income withdrawal, which is taxed at your marginal tax rate. And until you do one of those two things, then it's not crystallized. But with the modern drawdown rules, you don't actually have to draw anything. You can just say to your pension provider, I want this all put into a drawdown account, which effectively crystallizes it. So I can't see why you would do that without taking out the lump sum, because it's tax-free for obvious reasons. So for most people, it's going to be about extracting the tax-free lump sum and then moving the balance into the drawdown account. And if they've got an uncrystallized portion, we think, Will has been talking to AJ Bell just this week, we think it's 2 forms that we're going to have to fill out. I don't quite know why it's 2 forms. It hopefully might end up being 1 form, but you'll just send a form in and say, please move my crystallized balance into the drawdown balance. It may be that AJ Bell take a view, and it wouldn't surprise me at all that this happens in the next few months, that actually they'll just do that anyway, because I can't see why they would leave anybody in.
I think they would do that when the
benefits.
pension lifetime allowance is abolished, because
Exactly.
it's effectively uncrystallised.
So yeah,
They no longer exist.
so Sam is making a point there, which sounds perfectly sensible, although I don't think we've actually heard it from anybody, Sam. That's
no.
Sam with his chartered qualifications, thinking ahead and thinking creatively, that it's quite possible that when the lifetime is abolished, that distinction on your SIP account will just disappear anyway. So you won't have uncrystallised benefits.
You'll just have a tax-free cash allowance and a drawdown account.
Yeah,
but we'll have to see.
That makes sense. But I think if there's an opportunity before the end of the tax year to do it, and just in case there's a snap election or anything like that, if it's just a case of filling out a form and doing it, and we can't and we haven't thought of any reason not to do it.
You don't lose anything.
We haven't thought of at the moment. It doesn't cost anything.
And you can leave the money in there.
Correct. So you don't have to draw it. You don't have to pay any tax. It's just simply filling out a form. We can't see why we wouldn't fill those forms out and get them sent in, get you crystallized.
Makes complete sense.
I hope that answers that question.
Right, we're getting a bit more action on the Q&A front. For those of us with our own limited companies, is an employer pension contribution even more tax efficient due to the corporation tax rise to 25%? That was another change that was enacted in the budget. So, Sam,
good question. The answer is yes. In short, it's also worth noting that if you make an employer contribution, you don't pay national insurance as well. So even more so than just you don't pay corporation tax, you don't pay national insurance tax, and you pay it gross out of the company, and it goes into the pension.
And actually, people with their own limited companies, I happen to be one, are very lucky in that you can obviously control what you earn and what you declare as a dividend or roll up as retained P&L within the company. So when I said earlier that you can do £180,000 of pension contribution this year, the way we get to that number is by using what are called the carry forward rules. So we can carry forward 3 unyears at £40,000 each. So that's 120,000 plus the new allowance this year, which is 60,000. So if you were in a company and let's say you'd made £300,000 profit, you could comfortably pay yourself 75,000 PAYE. Then you could pay your 180,000 pension contribution using the carry back rules. If you hadn't paid any previously, if you paid previously, you have to deduct those. And then you could, you're below the taper relief. And then you could declare some as profit and retain it on the balance sheet or pay it out as a dividend. That calculation gets quite complicated quite quickly.
I'd say it's complicated very quickly.
So I guess, and we talked about this yesterday when we were preparing for this, one of the things I would say is that, we're not tax auditors at Tideway, we are tax advisors for sure, and we're probably more creative than your accountants are going to be in coming up with ways and ideas of making pension contributions efficiently. But what we'd always want to do if you've got your own company and you're having it audited is to work with that auditor to make sure that what we think will work with them and that they're going to get the right tax breaks for you.
And we do work with tax advisors.
We love to work with tax advisors. It works really well if we are saying we think this person can do X and the accountant says, yeah, that works, then great. And if the accountant says, well, no, you have to do it this way, so be it. But we sometimes find that accountants aren't always the first people to come up and say, why don't you do this? And so maybe you talk to us first, get some ideas about what's the art of the possible, as you might say, and then go to your accountant and see what they will agree to.
And get us all around the table. I think that's the ultimate.
You've got to be careful around tapering rules with that, but we know that stuff, so just come to us.
We've got another question coming up in terms of the age at which the lifetime allowance normally is crystallized, or what normally your pension's crystallized. So what about the test at age of 75 if the lifetime allowance is reintroduced?
Well, this is an interesting question because we haven't thought about this question. So I will answer it as the old funny daddy, and let's see if Sam agrees with me, because this is a sort of area where the lifetime allowance gets really complicated and why it's so deeply unpopular. I think the answer to that question is it wouldn't matter if they did, because the test at 75 is against the lifetime allowance that was in place when you crystallized your funds. And if there wasn't one, there's nothing to test against. So I think it's impossible for them to introduce something there retrospectively. But I'll ask whether Sam agrees.
I think so. The test at 75 is of your uncrystallized pensions. So if you
there used to be a tax against the drawdown.
Yeah, as I was going to say, the other one is against your drawdown. So it's if you've got more growth than you originally had in your pension at that point. Maybe that could be considered uncrystallized, but you can manage that by drawing.
Yes.
And
if you've drawn at a point when there isn't a lifetime allowance in place, I think it's hard for them to go back and create one retrospectively for you.
I think so, yeah.
So I think the answer to that is not impossible, but doesn't look likely.
I'd agree with that.
All I can say is to give you a little bit of insight into how Tideway runs its business. On a Monday morning, the whole wealth management team gets around the table together to discuss any issues which come up with any of the clients. And it's quite refreshing to see the open nature of the discussion. So in fact, whilst you might think you have one wealth manager who's dedicated to you, you really actually have a team of wealth managers who are always open and looking forward to engaging in lively debate. So thank you very much for that question, because that certainly gave a little insight into the nature of the way we work. Another question: are you allowed to use your pension income to contribute into your pension up to the MPAA, or the
And I'm going to let Sam
money
answer this one.
purchase,
This is way above
allowance.
my pay grade. Again, I think I know the answer, but I'm interested to see what Sam says.
That's I mean, why would you offset your income tax from your pension by making a contribution, would be my question to that. So if you're, I don't know, you take 30,000-40,000 out of your pension, you pay some tax on it, why would you offset it? Why not just reduce your pension?
So if it's a simple question of saying, yeah, can I take out 30,000, pay tax on it, and put it back into 30,000 and get the tax back? I'm sort of saying, well, why bother? Because you haven't achieved anything.
But if you've got some employed income alongside of it, you can offset that.
Yes. So what does work is taking advantage of the tax-free cash. Now, there are some recycling rules which I think are still in place now.
They are, yeah. Yeah.
So there are some recycling rules which, in theory, are supposed to deter you from taking your £250,000 tax-free cash sum and reinvesting it, getting 40% relief and turning it back into 400,000 plus in the pension.
You can't do that.
However, you say you can't do it, Sam, but you can. I mean, obviously, as long as you plan things correctly, generally you can do it over a 5 to 10 year period, because you know the revenue can't check whether you've borrowed some money then paid it back from the tax-free cash sum, or they can't check whether you've drawn it down and then increased your contributions in future years. They can only really check if you've literally taken it out 1 year and then put it back in at the same time.
Yeah, I'd agree with that.
So the recycling rules are pretty grey, pretty ugly, difficult to understand, and pretty easy to avoid, I would say. So I think optimizing your contributions as you come up to retirement and considering the tax-free cash as part of the liquidity that you've got to do that is absolutely a valid way to plan, and something we definitely encourage.
Why not? So another question, getting on to different ground now, back to the investment world.
Yeah,
and
it's a great question. So we
we'll definitely try to answer that. Do you think interest rate hikes are coming to an end? And do you think the rate will actually start to come down in the next 12 months? Now, James, I happen to know you've been in interesting investment discussions already today with one of the preeminent investment officers around the world. Presumably this must have come up.
It certainly did come up. So we're very fortunate, and we've said this before a few times, that we're very fortunate at Tideway to have some quite big cheese clients in the investment markets. And one of our clients happens to be the CEO and president of one of the largest pension schemes on the planet, one of the, I won't say which Canadian pension scheme, but one of the Canadian pension schemes. And so we've had a full, he's been a client of ours for just over a decade now, which is great. And he continues to be a client of ours, thank you. And we did have a very big debate with our two big investment guys about this today. And their view was, I think their view is probably at one extreme. You've probably got their view at one extreme, the central banks, what they're saying at another, and Tideway somewhere in the middle. So the central banks, like we had the IMF report a couple of weeks ago saying, you know, inflation will be down below 3% by the summer and below 2% by next year. And don't be surprised if base interest rates come down very quickly. This particular chief executive of this particular pension fund is of an opinion that that is not going to happen, that inflation will almost certainly be 4% or higher next year, and that assuming it's going to come down sub 3% by the summer is just fanciful. And his argument for that was pretty strong. The food crisis that's going on is what's causing inflation to spike. I mean, we have core inflation even in the UK below 6%, but it's taken over 10% by food and beverage inflation. And that, you know, there's some serious issues around the world.
And that's because of supply chain.
That's about supply chain of vegetable oils, grain, the amount of cheap chickens that there are that supermarkets can put on the shelves, blah, blah, blah. So that is not going away anytime soon. And then in addition to that, you're getting pay rises agreed. So, you know, the state pension triple lock is coming in with 10% added this year. There's 10% going on various other benefits that the government are offering. And, you know, we just agreed pay rises with the Lucky Tideway employees. And I'm sure if you other employers amongst you, you'll be knowing that you'll be getting pay rises well in excess of 2 or 3%. So I think that he's probably right that our general view is that inflation will be more sticky than the central banks are predicting. But there is going to be this effect, not this month and not next month, but the following month. So in June, we're going to see inflation figures plummet because of the fact that they're done on a 12-month lagging basis, and that 12-month period won't include the big increase in energy prices that came with the outbreak of war in Ukraine. So we will see for sure a big drop in inflation by June. Whether it will be down to 3% or not will be to be seen. But certainly it will be coming down, I would think, below 5% in June, and we'll have to see where it ends up in a year's time. I think we generally have the view that the central banks will be more sensitive to recession and pushing rates up too high than they will be to stopping inflation. Although they'll talk the talk, they're probably not that bothered about stopping inflation if it's getting sub 5%. That's kind of our view.
And there might be a slightly different take if you're the ECB, perhaps, as a result of the German.
Yeah, there's probably a slightly different attitude between the ECB and the central and the Bank of England and the Fed. Probably we're all getting more aligned on that because history is a long time ago.
That's true.
But you know, I think generally countries are much more worried about big recessions now than they are necessarily about whether we've got 5% inflation. So I think,
especially when they're in debt.
Yeah, I think we're in a higher inflationary environment for a little while to come. And I think whilst we're on this subject very quickly, I do also think, and this is where we were completely aligned with the Canadian pension scheme, is that this is going to affect short-term rates, not longer-term rates. So longer-term rates have only really just normalized; they're not high. You know, short-term base rates are now probably quite high. And so what you would expect, and we've got an inverted yield curve, so the shorter term rates are higher than the longer term rates, and they should be the other way up. So I think what will happen in the short term is that base rates will come down as inflation comes down, but I think the longer term rates will stay where they are, if not creep up a little bit more. So they're not, and we're not buying on any long duration bonds because we are worried about that risk of inflation, of interest rates rising for long duration.
Just want to make sure we finish this issue of crystallization.
Yes.
And there's a question come in, which is just, you know, when does your pot get crystallized? And the question is, as soon as you just draw down £1, is the whole pot deemed to be crystallized?
No, in short, no. So what you do is you designate your money to draw down, and you could designate the whole pension or a part of the pension to draw down, and that's the crystallization event. That doesn't mean you have to take money out. Yeah. You can take £0 out, or you can take £1 out, and that's your drawdown amount in your crystallization. So no is the answer. It's actually happening within the pension. Yeah.
Okay.
Rather than
now, if you take it as tax-free cash, then that's 25%, and that will immediately vest the other 75%.
Correct.
So if you take £10 out, £30 will be crystallized and put into drawdown.
£10 tax-free cash.
Yes.
Yeah.
But when it comes to taking income, you don't actually have to take any income. You just have to tell the SIP provider you want that money to go into the drawdown.
And that £30 is already crystallized, even though it's still in the pension.
So one way to crystallize a fund is take the 25% tax relief, tax-free cash sum, and assuming that's your account is below the lifetime allowance, that will vest the whole thing. But if you've got money over and above the lifetime allowance at the moment, you'll then have to make this further election to vest the excess portion.
which is an administrative.
which we will make sure is done for everybody if that becomes a need. So don't panic.
Don't panic. So question here regarding a client looking at a particular portfolio, and we talk about multi-asset growth strategy. And at what point should I reconsider my investment strategy, taking into account what we have heard from the current government, and that this year I have started drawing down my pension? So we've got a client who's in drawdown. I guess, obviously question marks around age, but nevertheless, given that we've got a multi-asset growth strategy, is that a sensible one to continue to be into? Have we got enough information even from that?
Well, I think it's definitely, the fact that the point at which you start taking cash out of your pension scheme is definitely a point to reconsider the investment strategy of your account. We've been talking about this today, and we think there are basically 3 gears for pension planning. So gear 1 is when you're just starting from scratch and putting money in, and it really doesn't matter what fund you buy. You're just paying money in, and it's what you manage to save which is going to dictate how big your fund is. Gear 2, or phase 2, is when the return on your account is bigger than the contributions you can make. And for most of our clients, that is the case, because they've been accumulating money. They've come to us, and let's say the pot is 500,000 and it makes 10%, it makes 50,000, and they're contributing 20. They've got more than twice as much from the investment return than they have from the new contribution. So that at the point where do we worry about that, Simon, or not?
Yeah.
No. So at the point where your fund is, if you like, earning more than you're contributing, that is definitely the first point to then reconsider your investment strategy. And then the next point on is when you start drawing, because there's a big difference between a fund in which you're adding cash to every year to one which you're drawing cash from every year. And so for sure, possibly you would consider coming down a strategy or two from the growth strategy. And what that would achieve is it would give you a higher yield on the portfolio. So that would fund the withdrawals you want to make without having to cash any capital in. And it would also give you more in short dated bonds and in lower risk investments, which would be there to back any one-off withdrawals or higher withdrawals that you want to make. So the answer is talk to your advisor.
Yeah, I think it comes down to circumstance as well. You're changing circumstance by going into retirement and drawing income.
Yeah.
But it also comes down to other circumstances, which is around your other assets you may have and what you're trying to achieve with the pension as well.
So
very good. Just one other question. We talked a little bit about employer contributions. So question is, what about employee salary sacrifices? Is that something which is on the cards as a result of the changes in the budget? So kind of enter into the fray?
Yeah, you can do that. You speak to your employer if you want to do that, and you can increase it if you want. You now got 60,000 to do on an annual basis. So potentially you could salary sacrifice 60,000 potentially if you can afford to do that, of course.
Yeah, I was talking to my wife Ursula about this today, because we run a workplace pension for the Tideway employees, and every year we get a large number of people sacrificing bonuses into the pension account. And also we know that a lot of people are going online and looking at the funds that they're in and picking different funds and making different decisions. I don't think that is the normal experience. You have to remember that we are a firm of financial advisors, so you would expect them to be financially aware and involved in their pension planning. I think a lot of people, younger people who are focused on employment and bringing up a family, they're in a default workplace pension and they're literally just paying the contributions in. They've ticked the box 10 years ago or 5 years ago that set the funds, and that's it. They're not worried about it. And that, I think, is quite a dangerous game, because you're missing out on opportunities to get tax relief, and you might be in the wrong funds based on what further contributions you're going to make and when you want to start drawing cash out. And so as you get older, it's more and more important to get some advice on your pension arrangements, is our general view.
And I think if you're in that position, pensions are set aside to where you want to put your money for retirement. So anyone who they should be very attractive, and they do remain very attractive despite some of the news around it and negativity.
Yeah.
They're the main point where you want to put money at the side as a.
And I think just another subject, Sam, in the ugly bits raised the issue of the stealth taxes. Stealth taxes are, quite well documented in the financial press. So we've had, 50,000 has been the tax threshold for higher rates of tax now for 5 years, 6 years, and it's frozen for another 2 or 3 years, I think.
Yeah.
So, and we've had 20% inflation in 2 years. So it's already £10,000 smaller than it should be. It should probably already be 70 or 80,000, but it's stuck at 50,000. So the point at which higher rates of the point at which tax bites and the point where higher rates of tax bite is actually getting worse for all of us all of the time because of inflation and because the bands aren't moving.
Well, inflation was so low, it wasn't so much of an issue,
exactly. So we had a
it's-
decade of inflation at 1 or 2% for, from the financial crisis all the way up to 2021. Didn't make it too much different, but suddenly now
it's changed.
From April 2021, we've now had 30 months where inflation has been ripping, and everybody recognizes we're going to have a debrief and we'll go and pay for a pint of beer in some fancy pub in Lebanon, and it's going to be an awful lot more than it was 2 years ago. And that price isn't coming down, that is inflation coming through. So we are all tasked with generating more net of tax cash to fund our lifestyles, and tax is becoming a more and bigger issue, and being tax efficient in the way you create that income as you move into retirement and switch from earned income to living off your investment income. That's where our advice can really help you, and that's where we should be really trying to reduce the marginal tax rate that you pay. And actually it's quite good. The situation in the UK is pretty attractive because we can plan to have income up to that higher rate tax threshold. We can take tax-free income from ISAs, and then for people who are lucky enough to have capital over and above that, we've got offshore bonds which still work really well, which give us the 5% withdrawal allowances, which are tax-free. So we can plan for 5, 6, 7, 8, 9, 10,000 pounds a month without paying very much tax. And if you're trying to to fund a retirement in that sort of bracket, or somebody who is trying to do that, then if they come to us, we'll help them do that in a tax efficient way.
And of course SIPs are outside of our estates, so
And SIPs, that's a fantastic thing to bring up as well. So one of the things that we don't really have the ability to put money into trusts anymore, but actually we can put money into pension trusts. So funding pensions for the next generation is a very attractive thing, and we're doing that for several of our families already, where the mum's bank of mum and dad is paying pension contributions for people who are due to economic circumstances aren't earning anything like we did when we graduated, and therefore it's quite a nice thing to be able to get the tax back that they're paying by paying in a pension contribution. And I can honestly say that in 30 years of doing this, nobody has ever come to me and moaned and said, oh my God, James, I've got too much money in my pension. It just doesn't happen. And actually the abolition of the lifetime allowance has made that even truer. So I think, setting youngsters in their late 20s and early 30s up with a few years of decent pension contributions can really set them on a good road. And that's something that, it can be done, very tax efficiently.
And when you're compounding growth,
effectively,
so over time is your friend, really.
Plus they can't spend it, which is also very attractive, because they can't get access to it until they're in their late 50s. So they might not like that, but it is
changing a little bit.
It is a form of trust. It's getting worse for them because it's getting older. But it is a form of trust that we can still put money into, and we can put £60,000 a year into. So if you've got a large estate that was well above the inheritance tax threshold, then paying money into the next generation's pensions is a very tax efficient way of passing money through now.
Very good. We're coming to the end of our time. We do have a couple more minutes, but I don't see any more questions as yet. Please feel free to post them if you do have any. I think the way I see it, and I'm delighted that I'm not as involved as you guys in the minutiae of the legislation, because it is quite complex. Nevertheless, the reality is we've had a game-changing budget. and
Yeah.
many people, especially those who've been able to build up pensions over time, have benefited immediately to the extent that they crystallize and there is no future political
Yeah, I mean, if
turnaround.
I look back at my 30 years of doing this, then pensions have generally got more and more attractive year by year. You know, so they used to be deferred annuities where they didn't have any value until you got to 60 or 65, and if you died, you lost it all. I mean, that was the sort of, that was still in place when I started in the industry in the 80s. And now we've got these, you know, much more flexible account. It's much more like a transparent investment. And probably the worst thing that was about it was the lifetime allowance, and it's gone. And I think, you know, despite what Labour say, I think it'd be very hard for politicians to bring it back because it's very complicated, very unpopular, and long may it be gone as far as I'm concerned. So
I think it creates, it makes it a lot more simpler.
Yeah,
And a lot more attractive.
and the government, you know, any government, Labour or Conservative, should be encouraging people to save for the future and support themselves. And therefore, you want stable pension rules which are attractive for everybody to rely on. And I think we've got a really nice set of stable pension rules now.
And I think it's fair to say, to complement that, we have an investment environment which is a lot more friendly from the point of view of diversifying portfolios, and to be able to diversify them a lot more cheaply. And that's been certainly one of the benefits of indexation over the last 20 years. So what we see is, you know, the fees that active managers are charging us have come down substantially over the last 5 to 10 years.
Yeah.
So
and also now
the
income that we can produce from investments has gone up substantially, and that's a really important factor because the income is generally much more stable than the capital returns. And again, you know, talking to the Canadian pension scheme today, you know, they're massive in infrastructure products. They're investing in our wind farm in the North Sea and all of that sort of thing. But we can, you know, that's SSE, which is our top holding in our global infrastructure fund. So we, although we don't have access to the unlisted stuff, we have access to the listed investments. And those are, for us, those are the sweet spot pension investments that are generating 6, 7 or 8% annual income, which is very reliable. And the capital will fluctuate a bit, but we know that the return is coming in year out. So the, you know, the credit bonds, infrastructure funds, high yielding shares, these are, you know, these are the investments which make sense in a pension where you're not paying tax to reinvest those coupons.
I mean, I think the other takeaway that I would have, you know, we talk about whether we're going to crystallize or not to crystallize. That's the question. There's no rush for starters. I think indication is from what you said earlier, James, that probably it does make sense to crystallize. We've basically been given this windfall avoidance of a 25% tax. But that's for the future. We don't have to make a decision immediately. And in respect to that, the best thing is to get on the phone and to talk through with your wealth advisor. It's nice to have someone on the end of a phone, I find these days. And as I said earlier, it is a team here that's advising. And if there are any issues that are particularly complex, we like to discuss them amongst the team. Separately, looking ahead, we do have another fund manager event on the 18th of May. That's in London. It's kind of continuation of a roadshow that we've had now in Manchester and Birmingham. And we will separately be in touch with respect to a summer webinar. I said this was the second of the annual webinars that we've held so far. We look forward to holding a third one in due course, although there's no subject matter agreed. Nevertheless, we look forward to doing something which hopefully is as topical as the one we've done today. Until then, please enjoy the spring weather. It's finally here, at least I think it is. As I said, if you do have any other questions, please feel free to put them on an email or get in contact with your wealth manager. Many thanks.